to another video, and today I'm going to show you guys a strategy for those who don't have a lot of money or just starting out, don't have the capital, but you still want to do option trading, because obviously for me personally, option trading allows you to give you more money. I mean, you can make more money versus buying a stock and just holding it long term. So for me, I love option trading, and pretty much not 100% of all my tradings are option trading. So one of the things you want to do right now is I'm logged into my Robinhood account and it's after hours. That's why you'll see my screen being black. Go log into your account and go under account settings, and then you want to click investing. Once you're in this section, this is where you need to enable it, okay? Because many people don't even know how, they don't have that option to trade. So you want to make sure that you're in here and that you have this section enabled. I already have it turned on. That's why mine looks a little bit different than yours. So if you already turned it on, okay, that's fine. So now let's go to the profile, and let's say you want to trade now. Now that you got that approved, now you want to start buying options, but obviously you don't have the money. So what can you do to trade and make some decent money at a low budget? Okay, so right now we're gonna go to a NEO stock. Okay, so now we're gonna click on, like, for example, and the reason I selected this stock is for the fact that I actually have a couple calls here, as you can see here. I'm predicting that the price is gonna go up, so I'm calling it that it's gonna go up. A put means that it's gonna go down. Okay, so, and the reason why I bought one is because, as you can see here, in the last couple weeks, NEO was up. The earnings came out and then it just dropped. But it's starting to pick up again. So I'm hoping that tomorrow we'll see a green day for NEO. But that is, if you wanted to do this, just follow my steps. So now you're going to hit trade options. Okay. So what I'm going to teach you today is called a debit spread. Okay, so this is how you're able to buy contracts at a low cost. Okay, so first, like for example, I have this contract already. Okay, so let's say we want to buy one, and we're gonna predict it's gonna go up. So we're gonna go with the 46 and the 45. Okay, so this is what you do: click sell, call, and then on expiration date, make sure you select. If you want to do March 5th, which is on Friday, or March 12th, either one. Obviously, the further out you go, the more expensive it gets, because chances of it going up to 45 or it's more likely versus going up to 45, a couple days from now. But for this video, we're just gonna select this. So remember, click sell, call, and then you're gonna select this plus right here. Okay, so now what the trick is, now you're gonna click buy and call, and now you're gonna click plus. Okay, so now that, notice what happens up here, and if you did it right, it's gonna say call debit spread up here. Now instead of paying $1.07, which times 100 is 107 or 146, now you're gonna pay 39 cents per share. So times 100. So now you're gonna pay $39. Okay. So now, as you can see, it's a lot cheaper now. So if I hit continue, let me continue, and if I buy one contract, I only pay $39. So I'm in the contracts. I'm buying contracts at a lower cost. Now, what's the catch, right? Well, here's the catch. You're not going to make as much, bottom line. You're going to make some money, but not a whole lot. So, for instance, we bought this one at 40, that's going to go 45, and that, the one below it, you always want to select one and then one below it. So, for instance, the difference between this is $1, okay? So, you got to times that by 100, because remember, that's what we're buying. So, if you were to buy this contract for $39, the most you can make is $100, okay, minus whatever premium you pay. So If I was to buy this for $39, so you will make a $60, almost a $60 profit. Okay, so yes, you're paying a lot less for the contract, but at least you don't have to fork out so much money. But the downside that you're capped on the earnings, so you're gonna make $60 total by investing $39 if this happens. Of course, and now you could just buy two contracts. Two contracts. I mean, it's under $100, or even three contracts. I mean, it's $117, which is a lot more affordable. And now remember, now that you bought three contracts, that $60 is times three. So now you got $180 you can make profit. But of course, keep in mind you have to subtract the whatever you're paying in cost. Okay. So now, if we scroll down here, okay. So now I'm going to show you the same thing. So this was a call spread call. Okay. So that we're predicting that's going to go up. So that's how you do it. So now let me just delete this. Okay. So delete. So now let's say that you want to predict that this is going to go down, but you want to buy a debit spread. Okay, so now you go buy a put. Okay, so we're gonna predict that it's gonna go below $43. Buy this one, then you buy a call. Now they have to be. Hold on, I think I did something wrong. Now, if you did it wrong, you're gonna see up here how it says custom. So that's how you know you did it wrong. Okay, it has to say a debit spread. So let me fix that. All right, so this is how you fix it. You go buy a put, and so we're gonna buy this one, and then you're gonna sell a put. Okay, so you always have to select the one underneath it. Okay, so here now you know if you did it right, that it will say here put debit spread. As you can see now, instead of paying $164 or $1.64 per share, you're only going to pay 41 cents. Continue. Obviously, we want one contract. So see how now we're only paying $41 versus $164. So that's what a debit spread is. Now, keep in mind, you're going to make money if it goes below the 143. Okay, if it goes over 44. Then you pretty much lose that $41. So that's the, I mean, it has the risk just like anything else. So for example, if we were to buy a call, okay, so I'm gonna buy this one. Okay, and then we hit a buy a call. Okay, so now see how I set a call debit spread. Remember, you have to hit sell call, select the whatever you want, and then you hit buy call. Because we're going to buy one and we're going to sell one. That's how you're able to get it so cheap, because we're going to buy a contract and sell a contract. It has to be the same expiration date. That is the trick. So, for instance, in this call, as long as the strike price goes above your call here, $46, you're good. You're going to make some money. You're going to make the profit in between here. But it has to go over your price. If it goes below the 45 from your put, then you're pretty much, it's worthless. The contract is worthless, So that's the trick to this. This is how you're able to buy some contracts at a lower cost using debit spread. Hopefully that makes some sense. Just give it a try if you're on a low budget. Again, if you have a little bit more money to risk, then I'll recommend a naked spread, a call, where you don't have to buy it. You could just buy it directly, and you will make a lot more. However, of course, it's more money. So if we were to buy one this directly, I would just click buy. That's gonna go up, and then we'll pay $107. Hopefully that makes some sense. I'll do another video buying this live and then show you the outcome. But for now, hope this makes sense. And if you enjoyed this video, just make sure you hit the like and the subscribe button. Thanks.